Okay, good morning. Merry Christmas, everyone. Um, Glad to see a few people here, but today's a great day to do nothing, take off. I just checked the markets. Thankfully, they're all closed, or the ones I looked at, the stocks. So we get a nice long weekend. Um, it's always very welcomed. I didn't check Bitcoin. I'm not going to do that. I want to start this day off right. So, and this is the way to do it. Talk to my friends in the clubhouse about trend following and what's going on in the markets from your perspective. Um, Got a couple of good things I noticed we could talk about if anybody's interested. Oh yeah, the podcast that I was promoting with Hedge Nordic with Harold, very good stuff. I tweeted the heck out of that, and I got more to go. I didn't even finish, but Harold is a pretty smart guy. I've always loved TransTrend. They've always been one of my favorite traders. And I always have a difficult time thinking I completely understand what Harold is trying to say. But this one, I felt like I understood a bit more. And but that's what you guys are here for, to discuss this with me. We can dig into what Harold is getting at. Being different was one of those things which I'm all for. Not too different, but maybe my kind of different. But no, in all seriousness, I think he's a leader and a great guy. And then a while ago, a friend Michael, he mentioned in a tweet that I keep saying that vol target trades are not system trades, and he didn't agree with that. So I need to explain myself because it is sort of something I just try to throw out there to get people riled up. And thank you, Luca. It's very good news. I trust you would have kept the Bitcoin move away from me if it had been down. So Bitcoin's doing well today. Um, yeah, so I try to just say these things, and Michael picked up on it. And um, it is a situation where doing the vol targeting is, like Richard said in his response, is it's there's worse things to it than calling it a non-system trade. It's messing up our uh, outliers. It's taking smaller profits than we should be. The non-linear it jeopardizes the benefits of beneficial nonlinearity at the expense of smoothness. Now we all know that's not good. So, but still, it reminded me of a question I put to the larger Top Traders Unplugged panel, where I said, just because you call it a rule doesn't make it right. And I think that's what I was getting at here. That um, in that idea was that just because you have a rule, and it may be a rule, obviously a low sample size rule, I think is problematic. And just because you call it a rule and you implement it doesn't make it right. And but then Michael goes on to say he thinks that these vol targeting, they are rules because they're part of your system. I kind of already said I disagree with that thinking. And I mean, they're rules, but they're kind of bad rules. But he also says that they have lots of sample size, which I don't know if that overcomes the problems with it. The commissions and slippage, of course, are problematic as well. Um, and then he did the back test, which I was particularly interested in, and basically says that while targeting, when he did it on his back test, it didn't do well, didn't make money, it reduces skewness and reduces profit. So, anyways, we can talk about those things or whatever is on.
Hi, everybody. Hi, Jerry. I hope everyone has a very happy Christmas. Yeah, look, I was very interested in that that email correspondence that you had with Mike, Jerry, because I was scratching my head a bit when he said that he had the sample size to support it. Because the way I'm sort of see volatility targeting is that I see it as a method to address features of a portfolio when we have these significant unrealized profits in the portfolio. For instance, a vol targeting method would be used to take some of those unrealized profits or reduce the position size from them to smooth the returns. So now the problem I've got in relation to sample size in relation to that technique is that the way I tend to do my trend following portfolios is that I test each of the individual return streams that make up that portfolio using a very large sample size. So every one of those return streams supports this large sample size, so that when they act as an ensemble together, I'm not doing anything to them apart from letting them all consolidate together and doing their own very happy, merry thing, so that the sample size is not affected through my method of compiling a portfolio. However, if for instance the vol targeting techniques do things such as adjust the unrealized profit of a portfolio because it's expressing very high volatility and they want to reduce that smoothness, really that's contingent on at that particular point in time how all of those return streams are operating together. It's a sort of statement of correlation, and this is where I think when we make these decisions to volatility adjust at the portfolio level, in doing so, we're basically eliminating all of that hard work we did on justifying or validating our approach with our large sample size through our ensemble of return streams, because by adjusting the position sizes, etc., of the portfolio to take the principles of volatility targeting into effect, you are changing the nature of the performance of those constituent return streams. Does that make sense?
Yes, and I was back in the day when my sort of backtesting got started, and I was talking to all my friends about backtesting. The way that it was handled would be you would do a first run through all of the markets with your system, one entry, one exit, a stop loss type of thing, and then it would produce all these trades, and then it would produce the equity flow. You combine those trades into the equity flow. Then on top of that software was built the money management, the risk management, and then you would apply those rules to smooth it out, either basically looking at the equity flow, and then adjusting those trades along the way to, step two was to try to smooth things out with vol targeting or reducing your position size when you had to do another market, like you're already in crude, but all of a sudden heating oil. And some of my friends would say, okay, if I have to do heating oil and crude, then I'm going to cut back the crude position. So that's sort of how the core system was sort of defined as your, entry, exit, stop loss, and then the money management piece was this add-on. So, but I think another way, I'm interested in your thoughts on this. Another way and so for me, the sample size is just like nothing's more important. And so, to some degree, um, I think it's correct to sort of go through how do we do this? How do we measure this sample size? So here's the types of trades that you do if you have breakout trend trading plus vol targeting. Okay, so one group of trades is breakout entry, breakout exit. Count those. Next group, breakout entry, stop loss. Count those. Breakout entry, vol target exit. That's another group. Vol target entry, breakout exit. Vol target entry, stop loss. 1, 2, 3, 4. That's the fifth one. And now the sixth type of trade is vol target entry, vol target exit. I mean, I may have missed some, right? But if you're vol targeting every day, his point is, I think we're going to have enough sample size. I mean, I guess I just really can't put my arms around this theoretically and say, is this correct? Is this really is basing a trade on that market's volatility each day, a little bit of a buy, a little bit of a sell? Is that real sample size accumulation? I can't really figure that part out.
Yeah,
But
I agree, Jerry. I was scratching my head when he said he had a large sample size to support his vol targeting, because I see it exactly how you're seeing it. We've got all of these different adjusting mechanisms, which inherently is significantly, tampering with that large sample size. So yeah, look, I see where you're coming from.
Hi to everyone. I'm late now. I don't know why. I think it's because of technical issue, because I saw that the room started only 1 minute ago. I think it's a technical issue. I want to say Merry Christmas to all of you, and I want to say that a lot of meaningful people for me in this room, and this year was a very happy year for me, and one of the reasons why I was very happy, these Clubhouse meetings is one of the very big reasons why this year is a very happy year. And so I wish you to be very happy, to you and to your families, to all people who are meaningful for you, to be very happy in 2022. I wish all of us good trends in 2022, of course. And I want to say that in the beginning on every meeting I say I'm very happy to be here, and it's total truth, and I always say it every time. And now I'm saying that I'm very happy to be here, and this year, as I said before, now this year is you made very happy year for me. Thank you for all of you.
oh yeah, well, you're very welcome. You make everything better for us too, Oleg. And I just wanted to let everyone know that Oleg picked up the ball last week and did it. I think so, maybe an impromptu Clubhouse meeting with some friends, and I listened to the replay yesterday, and he did a good job. So that replay is probably out there of Andre leading the group last week, and it's always good to hear from you and know that you're here with us.
I want to say that there is few things in life that is very meaningful for me. It's nature, it's my son, and it's trading. It's trend following. So, um, and I want to do all what I can to fight for trend following, to do all what I to do my best, and to trade as a real trend follower, and to follow my rules. And I want other people to know these rules. And I want trend following to be. I'm sure that, as Niels said once, that trend following trading style, the trends were maybe 100 years ago or 200 years ago when people did not trend following, and trends is now people do trend following, and trends exists, and in the future trend probably with a very very high probability will exist. Not dependent trend on trade people in trend following style or not. I like this idea, and I have said before many times that I think that transform it's the rules of transform, it's the rules of the laws. We transform, or transform is successful because the laws that give us the opportunity to capture these trends, it's the laws of nature in general, and I see it, and I've said it before and will say, I think many times in the future, that it's general laws of nature, and that give us the opportunities to capture the trends. And I'm sure.
So if we could just go into if anybody watched the podcast with Harold, yeah, and he talks about volatility and and how we need volatility in the portfolio. I don't really know if how he does it or what he's particularly uptight about, and discouraged about, obviously that the CTAs all became kind of the same convention that this is how we all are supposed to do it. And I guess he didn't like that idea. Um, but anyways, I thought that it was a really good podcast from him, and it was. I can definitely twist some of his comments into agreeing with some of mine. Um, I don't know. What did y'all think about? Anybody else get a chance to listen to that?
Yeah, I had a good listen, Jerry, and Harold's. It's sometimes very hard to interpret Harold. I love Harold, but the nuances he talks about and some of the things he says really strike. You've got to really focus on it and try and sort of dig deep to sort of uncover what he's trying to say. It's almost like reading these academic papers, which seriously, I'm often having a lot of trouble reading these academic papers or white papers on trend following because it's so different to how we talk about it in Clubhouse and stuff like that. But when you read these academic papers, you scratch your head and you think, God, how do you decipher this gobbledygook? But and sometimes with that thing with Harold, I certainly was scratching my head a lot of the times that the different speakers were talking because it was almost like a conversation that we don't have on Clubhouse, so they talk about this quest for uniqueness for their different programs. I don't know about that. I really don't know how to take it. What do you think, Jerry?
Well, I think it's just back to the same old thing that it's just it's just normal in the way the trend works. And I think even I remember a podcast, maybe it was Top Traders, maybe it was our big Top Traders with everyone, where it was just, or maybe it was Campbell Harvey in that podcast, where it's just a known fact that we all vol target. I mean, that's just the way life is, and that's the way CTAs do it, and that's it, and the end of discussion. And that's sort of, closing off the debate is something that I have experienced with that group, for many, many years. And I think that, and basically he's saying, I don't know. He's saying, like, let volatility into your portfolio. We got to have volatility. And so I think he must be complaining about that in a gentlemanly way. Me, I would just go straight to the issue. And then, then the biggest mistake of all time with all CTAs has been no single stocks. And hey, we just do the indices, they're futures, we do them. Everyone does them. I mean, not everyone. You got the weirdos who don't do them. But come on, let's just get with the program. And this is how we do things. This is this style and convention. And even when I had a big business, I mean, I would go into these marketing meetings and I would get all kinds of, and I would be pushing like more single stocks, more diversification, um, add more markets. And my marketing crew would be like, come on, man, let's just be part of the group. We'll get the group of CTAs is going to get 5 to 10% of portfolios. We'll get 5 to 10% of that. Let's don't have performance that's outside of that's too unusual. If the industry is down 5, let's be down between 6 and 4. If the industry is up 5 for the month, let's be up between 4 and 6. So it's just that human beings crave, I think to some degree, this. We're all in it together. We're all in stocks, and if stocks go down, we're going to lose. We're all going to lose. So let's don't rock the boat and try to come up with something too new and different because we're set where we are. And I thought that him coming down on that was pretty interesting. And then he says, I didn't really understand all of this, and honestly, I don't think I have looked at this idea in a long time. But he makes the direct claim that if you have daily volatility, a lot of daily volatility, and then that's going to translate into shorter and shallower drawdowns. And now I'm all for this, of course, because this is what I advocate, this daily volatility on your open trade positions. But I really have not ever made this bold claim that it's so wonderful because it makes your drawdowns smaller and shorter Whereas the opposite of smoothing the returns, he says, and getting rid of that volatility makes the drawdowns deeper and longer. And
That was very interesting what he said there. Yeah, I was wondering about that myself, and maybe he is right. Maybe there is something to that, because I do notice that these very volatile programs like the classic trend followers, they certainly recover quickly from drawdowns. Like it's a real growth spurt back up. But I do notice with some of the funds that I'm tracking that are certainly smoother, that it takes a while for those drawdowns to recover. It's interesting.
I think my take in the at the abstract level is that they were wanting their cake and eat it too. And what I mean by that is they wanted to say that everyone's similar, but yet we're all a little different. And although that's true, lumping, as Jerry was saying, everyone in as vol targeters, I thought was kind of a little disingenuous. But I just, that was kind of my take on it, was that they were wanting their cake and eat it too. And then just to end on something here with Oleg, thank you for your inspiration and passion for trend following, as an average Joe like me. And you should also give yourself credit for sticking to the process and being disciplined, because a lot of folks bail and jump from system to system. So you deserve to pat yourself on the back there too. Thank you.
You're welcome. This was very pleasant for me to hear this. And I think that being consistent and persistent is a very big part for success.
Of course, going back to that smoothness and the time it takes to recover from a drawdown, I half suspect that smoothness is a symptom associated with sort of incorporating a degree of negative skew into the portfolio, and therefore that's why I can see it takes a long time for those drawdowns to recover. It's actually interesting in that presentation how they put the graph of long-term capital management up there when they were talking about negative skew. That was quite fun.
I agree with you that trying to control certain moments of the distribution introduces distortions and effects, like duration of drawdown. And my experience has been that although I don't follow things the way you do, and I have not only I not only size or my risk by volatility, not of my own returns, but by the underlying instruments, and update that every day. But I also have a continuous way of working out signal strength. So the interplay between the two, I think, is working different than doing straight vol targeting, as probably was implied by his words, on digital positions. I think digital positions and vol targeting are strange bedfellows. But back to your point, Richard, yes, I mean, you're trading, when you do vol control, you're trading for skewness or other things. So it can affect the length of your drawdowns. But being a trend follower, you're probably 90+% of the time in drawdown. So I'm less worried about the duration of my drawdowns, but I'm more worried about the depth of my or the shallowness of my drawdowns. So I found that having a somewhat robust, and I keep insisting on this point, and rolling standard deviation is definitely not the right way of going about it, but having a somewhat robust way of managing volatility not only improves Sharpe ratio, which nobody cares about, at least in this room, nor do I, but it helps managing that volatility drawdown, which is really expensive if you think in geometric returns as opposed to arithmetic, but also has the benefit of extracting the positive gamma convexity of trend following and monetizing. So booking profits. Obviously, if you're doing it to the extreme, so every day you are in profit, you cut your position, you're hurting yourself skew wise as well as return wise, and probably even drawdown, because instead of getting the big kick up, you sort of handicap your positive trades very quickly, and your negative trades obviously are subject to enormous stop losses. So in the end, your equity curve looks like a mess. But I still go back to my point that even if you vol target, the property of trend following are that of a positively skewed strategy, though less so than you in your world. And more importantly, it doesn't become negative through vol targeting. I think it only tempers the positive skew. That's been my experience anyway.
Yeah, and I think, although I don't think, I didn't hear you say, or that you disagree that the vol targeting part is not negative. According to Michael, it is negative. It doesn't make money, and it's negatively skewed. So, but back to my rule thing, and I've repeated this, I've said this before, but I think that it's fine to have these rules that reduce your vol or take some profit. There's been some horrendous movements this week against some of my beloved positions. Dollar Turkey, that was kind of a crazy profit give back. And then I was looking really good Thursday in the UK and Dutch natural gas, but they had some horrendous moves yesterday as well. So I think, when you get these crazy profits and they're straight up parabolic, you get nervous, then I would have a tendency to scale back a bit. The ATRs are out of control as compared to when you put the trade on. But it's kind of like, rather than a daily diet of this with these precise formulas, I'm like, okay, get out of 25%. And so this is like certainly non-robust. It's barely a rule, which is used to make sure you do the same thing every single time. So maybe you do want to make it a rule, although this is going to happen with outliers. So the sample size de facto doesn't exist because they're outliers. It's 5 to 10% of our trades, these mega profits. And so I think that's a better implementation of, look, I know it's random. It's kind of like this discretionary thing. And I'm going to do it when I get nervous or whatever. And then I'm going to go right back to one entry, one exit, and a stop loss. And so that's what I advocate. So I'll flip right over to, zero sample size. That's perfect. I mean, just acknowledge it to yourself that I'm going to do this because I don't like this vol and I don't like this. And it's not going to outperform over a long period of time my core system. I thought that Harold also talked about discretion a bit. I don't know if I can remember exactly what he said, but he was all in favor of discretion and using a bit of discretion he thought was just fine. But I don't remember exactly why he said that. He said it's like flying a plane. You got to be the pilot all the time. You're going to fly the plane versus flapping your arms, but you need to. The trend following systematic approach does need a pilot who can make sure things don't get too crazy. I guess that's what I'm saying. When it gets crazy, you don't need a rule. You don't need to convince yourself you have sample size. Just do it and go back to feeling better about yourself.
And I think that we must have rules, because I don't remember exactly who was talking about. I remember now, Mark Jabrzinski, as I remember. He said a good thing that in military forces, people now have very good discipline and have rules to follow. And in the battle, they see uncertainty and they feel fear, they see uncertainty. But all what they have, in fact, is the rules and the discipline to follow these rules. And following these rules will minimize their problems, if we can say so. So I think discipline and rules is very important in uncertain situation. I totally agree with this. And also, I think we must not to be. I agree with Niels and with many others who say that we must not be very complex. That complexity isn't the best guide to our trading in our trading way.
Yeah, what I'm finding very interesting is that, you know, from the stuff that we do within Top Traders Unplugged, when we all get together, the stuff we do in Clubhouse, we find that I feel as though there is a bit of indoctrination going on here, because we all tend to sing the same tune. Now, where I have my problems is when I see these podcasts like what Jerry put up with Harold and I think these other fund managers who are trend following fund managers like Quantica and Aspect and these sort of things. And when you're hearing their conversation, it's almost foreign to me, because I've been talking in a venue with Jerry, with Niels, with Moritz, with Rob, et cetera, and our conversations genuinely, you know, we tend to sing to the same tune. But when you sort of get into these new formats, you suddenly think, crumbs, am I missing something? Am I thick? Why can't I understand these people? I find it very interesting.
So to go back to Jerry's question, I do think that targeting is that element, yes, must be negatively skewed, because if it reduces the skew of a traditional classic trend following, then by definition that element is negatively skewed, though is not sufficiently negatively skewed to flip trend following from a positively skewed strategy to a negatively skewed strategy. So that's the point. And back to your point, which is very interesting, that you exercise discretion rather than daily dose of. Perhaps it's worth going back to the point I think I raised last week. I was trying to give you a little bit of an insight of how it happens in my world. I actually demanded that same element of your discretionality because I don't trust myself well enough to a systematic, so to a rule. And the rule tests every day, almost instantaneously. I obviously pay attention every day to changes in assets volatility, so each individual instrument volatility. If that goes, reacts in ways, if it moves against me, I'm very quick at obviously acting and cutting positions over and above what the signals imply. But if things are going in my favor and I'm fully scaled into a position, I mean, I don't want to do exactly what you were saying. So, cut your position too aggressively and lose part of the uptrend. But if things go really crazy, so, you have a multiple expansion in terms of, volatility. So your ATRs are really very, very high relative to what they were in the past. Well, then, I'm acting and monetizing, and that's what I call the positive gamma. So I'm monetizing that gamma, thinking that if things are so extreme and they go parabolic, then round the corner, there's a big drawdown and this big give back. So I think I try to do exactly what you describe as your discretionary rule, but in a more systematic way. And of course, I'm going to be worse than you because you're a better trader, but also because I had to trade off between, being objective and being prescriptive about it versus exercising, human judgment. Of course, a computer is going to be somewhat more restrained than a human, but at the same time more effective in acting when it's needed.
I agree with that, Bruno. I think what both you and Jerry are doing, Jerry's doing it in a discretionary way, you're doing it in a systematic way, but I must admit I'm a Nazi and I do neither of those, so I let my system rules play out and I will not interfere with them. But I suppose that's just a slight difference in philosophy.
But I would also hazard a guess that, and just in listening to you for a while now, Richard, that at least compared to me, that I have I have no short-term systems, and I build up. No one builds up bigger open profits than me because my systems literally never get out. I mean, it's not like a brag thing, and then nobody gives back more profit than me with the core system. So I don't have anything that could even possibly be considered medium term. It's all super long term, never gets out. My shortest term system does on average one trade per year. And so if you look at my risk to exit, Niels's favorite number. I mean, it's just horrific. I couldn't even sleep at night if I looked at that number. It is crazy. So that being said, you probably don't feel the pressure. Systems I think are more able to, in one way or the other, preserve more of the open profit
I
than.
hear you, Jerry. I hear you. And look, have you ever been at least considered perhaps including more shorter term systems in there? Whether or not they're extremely profitable, that's not the point. But what it is it provides that sort of hedge trade when you get those major turning points. And I thought, with your situation where you've got this amazing unrealized profit there, wouldn't you like to have some at least short term trades sort of hedging part of that? What are your thoughts?
I would, and I think that I think you threw in. It's not the point. I think to me it is kind of the point. I do. It's not the point that if they're not that profitable. So to me, yeah, that is the point. They just have to be profitable. And so, as I've said before, I will run these back tests and number one, look to see how the different exits, how they perform. And number one is, do they make as much money as the shorter term exits? At some point, they will. If you go too short term, they'll stop making as much money as the longer term exits, and then so you have to just pick that point. Okay, 50 days lower is too short term, and it doesn't make very much money, and the average trade is too skinny, and it may turn out to be that after you apply commissions and slippage, that average trade is way too small. And so I need to have my average trade at a certain level that can absorb slippage and commissions, and then make about the same amount of money as all of these systems, which all the systems that I trade, they make about the same amount of money. So the only difference is that some get out sooner than others, and their average trade is a bit smaller than the longest term one, which has the biggest average trade. So to me, adding in things or approaches that make less money when I've already convinced myself that I'm protecting capital, I'm taking small losses, I'm moving the trade level up slowly. What I'm experiencing on these turning points is just the vol and just open trade profit. And these longer term systems, they make more money. I cannot convince myself to go backwards and say, oh, I really am super freaked out about when stocks sell off like they did, in November, and they go right back to the highs. Well, yeah, that's what usually is going to happen. But even if they don't, when the dust settles, these longer term systems, they make more money, and I have to sort of go with that.
You've sold me, Jerry. You're right, of course. Yep.
I was laughing when you said that.
By the way, it was very, very important information when I get known this from top traders on block, maybe 2 years ago, or maybe more, maybe 2 years ago. And it was very, very important when I understood that long-term trading is more profitable and it's less nervous. And as I said many, many times before, that I was a short-term trader, even intraday trader, for a few years, and when I understood that, I thought that the result will be the same. So if we trade a short term, we have more fast results, and if we are trading long term, we have the same results, the same performance, but in more longer period and longer and bigger drawdowns, not bigger but longer, I thought. And it was my mistake. I did not have such a big amount of data to test this all. I did test backtest, but this backtest wasn't perfect. And I'm very thankful that Jerry, Niels, and Maurice told the people, and included me, uh, that it's not the best approach to trade in the short-term period, because um, I didn't want to be a short-term trader. I was short-term trader only because I thought it's better, because I said the reasons why.
Well, I think where duration can play a significant role is for at kind of what Harry and Niels were talking about on one of the questions from, I think it was Mervin, on their recent discussion on AI, and that's that you have the size. There's a devil to being too large and a devil to being too small, and I think where you're in that particular predicament, your your frequency may be an additional diversifier. And so I think that's where it may actually add some value. But I've seen in my own where my short term system, if you look at it when it's in your total returns versus out, you'll see that it does kind of give some convexity to the returns, which may not be something that somebody trading other people's money may want to have, that those of us trading our own can have. But I think that's where there may be some value for larger and smaller accounts is in the duration of your trend.
Short-term system, at least, it's harder for me personally to execute. When we, of course, only, but if we are talking about psychological reasons, it's maybe more simple because we do everything all the time. But as Neil said, that doing nothing is also doing something. So, in investment world, it's better to wait. And Neil said very interesting things, that there was a research in Fidelity that the best accounts was accounts of the people, were accounts of the people who have forgotten about these accounts. So, very, very long-term accounts were the best accounts of clients of Fidelity. Very interesting information, and let's share this in one of the episodes.
Hey guys, everyone. First of all, very Merry Christmas for everyone. I would like to say I'm very thankful for this Clubhouse too. Just like Oleg just said, one of the best things in the year, definitely. Thank you everyone. Now to the short term versus long term issue. I've been experimenting with some backtests on different system setups, and definitely one thing that I found is longer term systems do have the best performing trades. That there's no doubt about it. They can capture the outlier at their best. They do not give up trades early, and they have massive returns when they do occur. The problem I find is the problem with these long-term systems is that they do few trades. So when you line up these trades one after the other over time, you get a total return in the end that's not that much better than a medium-term system would have. Now, the medium-term system do have a benefit that every time they exit a trade, you can recalculate your closed equity and resize the next trade. If you have markets to do that for you, you have I don't know, about 70 markets or something like that, you can exploit the benefit of much better than longer term system. And then the short term systems do have a role to play here, because they help mitigating the drawdown the losing trades give you. As they help mitigate your drawdown, they they prevent the equity curve, the closed equity curve, going too low, and protect that compounding effect I was talking about. So when I compare the equity curve of a system that has longer term subsystems versus a system that has a combination of medium and shorter term systems, I find the second one is better. And just to be clear here, the shorter term systems I'm talking about are not that much short term. The trades go on for about a couple of days or weeks. It's not definitely not high frequency trading I'm talking about. Do you guys have the same impression or something different?
I do, Bruno. My short term is again based on the old point and figure, and entry is on the breakout after the break of the trend line. So I'm not getting in and having high turn. I'm getting in more as a kind of a swing in the direction of the trend, where my trades may last anywhere from 2 to 4 days to months. It just depends on how that trend
Uh,
goes with direction of the sell signal on the downside. But everything else is pretty much traditional turtle trading after that. So I didn't mean to seem like I was there clicking the mouse like a hamster.
I want to say that I'm not on 100% against this combination, but I think I don't want to do it for myself, and the reason why, I remember even Niels said in one of the episodes of Systematic Investors that usually uh, fund managers trade or short term or from medium to long term, and I think there is a reason why it is so. And I want to say that this combination, I think it's a classical way of trading from medium term to long term is better for me personally. I don't see this combination looks not bad for me, not bad, but only looks. But I think, yes, of course, when we have a long drawdown periods in a long-term space, we can compensate it in a short-term space. But if we do all the math, I think that it's not the best decision. I don't want to say that this decision is have no right to be, but for me personally, I decided, and I'm talking like an ex-short-term trader, and I decided not to do this. I thought about this, I did research on this topic, and I decided, like I say every time, I have not found something that is better than trend following medium to long term in its classical way. So I don't see the reason of such combination. So I don't see the reason for me personally to combine, for example, trend following system with mean reversion system. I don't see the reason, and it sounds very good when we trade, for example, on a long-term basis and have a short-term mean reversion system. Sounds good, but I don't see the reason to do it for me personally.
Yeah,
We,
I think you raise a very good point, Bruno. I think what we're talking about here is this is the difference between trading a small account size and trading a large account size. So when you're trading a large account size, you're unbridled. You don't have these limitations or these obstacles in your way. But when you're trading a small account size, I definitely follow your path where I prefer multiple systems, short, medium, long term, in my portfolio, simply because I am shackled by some of the limitations of my small finite capital amount. But if in a theoretically unbridled way, if I had unlimited capital, I would err on the go to the medium to the long term and just focus on that and achieve extensive diversification, get into China, get into all of these alternative exotic markets that are still liquid. Build your diversification. Exactly what Jerry's doing. I think the discussion here is more a case of it's a nuance between the limitations we face as small traders, because as small traders, we ultimately need to reduce that impact of our drawdown to get the biggest bang for buck we can out of our compounded wealth. And those drawdowns can severely limit our compounded returns, right? Geometric returns. And that's why, I see where Bruno's coming. I can see why he's doing it. I see why Derek's doing it. I see why I'm doing it. I see why you're doing it. It's these limitations expressed by our finite capital that is almost forcing us into this corner. But I also see where Jerry's coming from, and I think ultimately, when you're not unbridled or you don't have these limitations, go for the biggest return, and therefore medium to long term models are the way to go. But expect volatility with it and just embrace it. But with your broader diversification, you can achieve with your greater account size, your far broader diversification into stocks and all of these things that Jerry's talking about and stuff, that does produce these correlation offsets. It actually does reduce that impact of that drawdown that we, with our small accounts, face because of our limits of our practical ability to diversify.
Oh, yes, very good. I like that. Yeah, I think what you're saying is that it's okay if you can trade 150 markets, like I can, and all the currencies, commodities, stocks, bonds, commodity-linked stocks, and then it's easier to sort of discount the benefits of that you would, if you can't trade all those markets, that you could see picking up by trading shorter and medium term. I I definitely, so I have the luxury, or if you can trade 150 markets, anyone can have that luxury of just letting the markets do all the work. Because at the same time, I'm facing these drawdowns in nat gas and Turkey. The positions are so small, because I trade 150 markets, and then Bitcoin is rallying, or something else is helping, bailing me out. So the diversification is kind of working. Lumber, I never got out of all my lumber. How crazy is that? These trends, they come back sometimes. But yeah, so I didn't finish what I lost my train of thought about choosing the system. So, I just try to go out and find the shortest term I'm comfortable with, and that has that nice average trade. It makes about the same amount of money as the longer term stuff. And then that's where I just put my anchor right there. I'm not going shorter term. And then I figure out the longest term I'm going to trade. I don't want to get too crazy out there. And one of the downsides is this lower sample size the longer term you trade. But when I look back at all the other systems I trade, they all make the same amount of money. So should I get too nervous about trading a longer term system that makes about the same amount of money as the shorter term systems? Probably is not a good. I shouldn't take too much comfort in that, I guess. But and then I just sort of trade everything in between, or as many different parameters in between my longest and my shortest, without really doing much of a back test. I'm not really going to be too concerned if parameters in between are not don't test out quite as well. But then with what Bruno was saying about being able to resize the medium term, you're booking profits quicker. You're able to resize your trade level. But I don't really resize my trade level that often, and I don't base my trade level on today's closed trade equity. So I'm not really taking advantage as often with, I wouldn't be increasing my trade level with shorter term systems because I make it, I don't increase my trade level. I don't really go with whatever the trade level is, the closed trade level is, closed trade equity is today. I don't really use that. I move much slower than that. But there's so many other things going on in all of these shorter term, medium term, that you could kind of reach inside and describe. Oh, it did this trade this way. It protected me. It's kind of funny that within a large group of parameters, they all make the same amount of money. So whatever benefits my shorter term system has over the longer term, it's obvious the benefits it has. It doesn't get back as much profit. Well, it's totally offset by the fact it stayed in lumber, and it's lumber's going back up again. Bitcoin's going back up again. So it's kind of funny how the pros and cons of all these systems, the market and the backtest is never saying, aha, that's the one. That's the element here. You really need to focus in on being shorter term. No, you don't, because sometimes that works better and sometimes longer term works better. One of the things that I think does definitely impact returns as well is having to resize the position. Like if you have your Moderna on when the ATR was 87 cents at entry, that is quite a damn big trade. But now if you got out and you're going to think about getting back in and the ATR may be $25, that's quite a different trade. So I tend to focus sometimes on, man, I really don't like these drawdowns. I really don't like losing this money. And then all of a sudden I'm reminded, wait a second, I should be more focused on maximizing this trade, Moderna, that's scaring me to death, that's impacting my P&L so dramatically, so unnecessary, right? But this is how we bring value to clients, and by getting them involved in these crazy outliers, and then having the discipline to not get out too quickly.
We have an expression is that the blanket is too short for you to cover your head and your feet. Yeah, you there's definitely not one single aspect or one single answer for what's best. It's hard to come up with a combination of systems and parameters that you find, okay, this is good enough, and I can't find anything that's meaningfully better. No, when you look at the different angles, you can find um, um, a deficit of performance, or a deficit of features in your system that, oh no, perhaps if I change this thing here, um, it will improve my system. It's an ongoing, a never-ending task.
So, we talked about this before where shorts, okay, so shorts are not that great. So it's kind of like shorts are my short term system. That's my sacrifice. That's where I'm willing to say, yep, I'm going to make less money because I'm going to do these shorts. They're probably going to be mostly just for diversification and sample size, because my average trade is the average trade of all the trades, longs and shorts, not just the longs. And I need these shorts for sample size, for confidence. They will bail me out sometimes. They will give me some momentary profit, but it's not going to give me 500 ATRs more than likely, right? 300, 400, 500 ATRs with these systems that don't get out for a year or two. This is what a new large trade, this is, I think everyone's definition of an outlier is kind of dependent upon your parameters. So when I was in the Turtle program, an outlier was 20 ATRs. Now it's 200 or 300 because I'm holding on a lot longer. So that's my sacrifice to the trend following gods for embracing less performance for diversification and risk control. But darn, you want me to now trade shorter term when I think that we're constantly reminded by others, outside researchers that long term really works well, and it also works so well in choppy markets like cocoa, which I've lost money in, but way less than almost anybody else. I just haven't done many trades. They've all been losers. Wheat, look at that wheat chart. I mean, all 4 or 5 of them. I trade 5 different wheats. I mean, to stay in that trade and still be long is miraculous, and it hasn't made that much money, but it just could have been so many losing trades in and out with these losses. So it's another benefit of a longer term look back.
I also wonder what the crossover is between short-term systems becoming negatively skewed once again, because if you think about it, really short-term trading should be a convergent strategy. And I'm not just talking about high frequency, which it is, and none of us do. But even I think I haven't practiced a lot in short term. My shortest term trades last for about a week, and I wouldn't go any any faster than that, because obviously short-term trading means more cost, because it means obviously more volume, more executions, and so more cost. But there's a crossover at some point where you really are forced to do only convergent trades to be short-term, and therefore that negates the big, much more than vol control, in my opinion. That negates the big attributes of what our systems are trying to do. So I can see a big conflict there.
Term systems I'm talking about are these about a week or a bit longer length of trades. They're not too short term. They're if you have if you line up the trades of this short term system over time, you see a trend following equity curve, definitely.
Yeah, and then as I've said, I'll scroll through these charts, hundreds and hundreds of charts, and if you put up a weekly chart, I mean, these long-term trends, they're just everywhere, and you're sitting there going, man, I mean, and the drawdowns, on those weekly charts, they look so small, right? I mean, they're not, but your eyeball is saying, wow, look at that big move. You've made all this money. You've not done anything. You've allowed this market to do all the hard work for you. And is this a good lifestyle? And I'm like, yes, this is a very good lifestyle. I don't want to have to do too many trades and be in and out of the market too often. I mean, I could never do anything. Maybe a system that did a trade every 6 months. I'm already at one per year, so maybe one trade every 6 months would, because we're just every day I'm reminded with all these great trends where the big money is, where the material money is, and that none of these moves mean anything. Limit up today could be limit down tomorrow. You're really excited going home on Thursday night with this natural UK nat gas position, and then it crashes the next day. It'll probably rally on Monday. I mean, who knows? And so we're always reminded that uh, these the in and out of these markets and what they're doing is they're not reliable. If we have these big trends, they can be very choppy and very lumpy, and not really cause a lot of anxiety if you're really looking to make a trade. The trend is over. There's no such thing as saying I think the trend is over. It makes no sense to a systematic trend follower, because we're not really trend following. Trend following is not above our system. Our system is what we're doing, and in analyzing the system after doing the back test, we're saying, aha, I see what works in the market. It seems to be something they call trend following. With these different entries and exits, there's a lot of parameters that work in this area. But that's our goal, is to just follow those parameters in those systems and take advantage of these moves. But I'm always like baffled when people say, well, I think this indicates the trend is over. No, no, because I mean, I may have gotten out of system one, I'm still in system two. And I'm following these parameters. I'm playing a game of following parameters, not looking at charts thinking that the trend, it's pretty obvious that the trend is over or it's continuing. It's subject to change at a moment's notice.
The meaning of turtle trader is that the turtle faces life in a much slower way. Look at weekly charts, monthly charts. Don't bother the daily.
Yeah, I think we've got to always remember that the trend is what the market delivers. Our systems are just the methods we use to extract that edge from that trending market. And the form that trend in that market can take can be very ugly, but it's still a trend. And our systems might capture aspects of that trending signal, but yeah, the bottom line is if we get too prescriptive in trying to define systems as the things that decide when the trend is over, then we miss the whole point of what trend following is all about.
That's right. Some of my friends, they're in industries where they are concerned with some of these markets, and they'll call me up and they'll say, what do you think about gold? And I'm like, I mean, I don't know. I mean, I don't really have an opinion. I'm long. The trend is up. Now would be still a good place to go long or short or whatever is going on. But I have no opinion. What's going to happen, or it could all change tomorrow. and then I'll hold on to that position for another year or two. So it's just that the markets are they're not telling us anything. They're keeping all their secrets to themselves, and we're just loose pants. We're loosely following them, letting them do their thing, and you can see the paths of all of these different trends we've seen recently. They're crazy. They're none of them are the same. All I know is on most of them, my exit was far away, and whatever they decided to do before they went 400 ATR or 300 ATR, it didn't knock me out. But it's so irrelevant and it's noise until they decide to stop going up and reverse.
So what's the New Year's resolutions for 2022? That's what I want to know. Jerry, what are you going to be doing in 2022?
2022, more of the same, adding markets and talking
Are you
about the
going to go? Are you going to
benefits.
go into China?
I'd like to. That is very difficult. The aspect guy on Harold's podcast was bragging about that. Yeah, I went through all the China markets. That's how I'm trying to push towards China. It's a lot of hurdles and legal requirements, and they don't, China is not ready for US CTAs yet. They, we're ready. They should be ready, but they're putting up these roadblocks. But I went through all the China markets, commodity markets that we don't already have access through via Singapore or crude. There's crude. There's copper, which I feel like I have access to already. And I look for stocks that might be involved in some of those commodities. So I'm just always relentlessly researching the trying to find a commodity and that I don't have exposure to, and then maybe looking for a stock somewhere in the world that might benefit from the supply and demand of the commodity that they're involved with. How about you, Richard?
Yeah, look, I think next year is where I might start going into single equities. So I think you've convinced me there, Jerry. So that's going to be my research project. Also, look, I am doing a bit of a research project at the moment, looking at short-term models, but I am starting to come to the conclusion what Bruno P was actually saying, in that when I try and fix this short-term hiccup, I'm finding when the Black Friday event or March 2020 event where we get a very short-term reversal and then a kick up, it does force you into the convergent models, and you do find that you start introducing negative skew. And so I'm thinking to myself, just accept the drawdown, Richard. That's what I'm saying to myself. So I think I'll probably be coming off that research project with no sort of with no solution there, and just accepting the fact that I've got to embrace that occasional, weakness that I find in my portfolio. So equities next year, I'd be interested to know what Bruno P and the other Bruno is going to be doing for next year.
Well, funnily enough, I would like to become more like Jerry, because I think one of his biggest skills is picking markets. So I need to expand my tradable universe. Right now, I'm around 100 markets. I would like to go a little bit higher than that. Account size wise, obviously, I'm always trying to grow assets, but in a way that fits my own philosophy. So again, Jerry, I think, has been very savvy in making sure that there's process before marketing purpose, and that's another very good very good principle to follow. But my number one item on the wish list would be expand to more markets, and exactly what Jared was talking about, finding those commodities or themes or underlying wish or forces that push the market higher or lower, but create big trends that we're trying to capitalize on. So instruments it is for me.
Next year will be full of new markets, definitely. And I want to study options and see how they mingle with trend following. I have a feeling that long vol strategy can be beneficial to my portfolio. Just like we were talking the other day, our give backs are huge when correlation goes to 1, and when correlation goes to 1, it means the S&P is going down too. So a long vol in S&P or through the VIX can be a way to mitigate this. I don't know. That's what I'm looking for research next year.
One of the things that also I want to, as a lesson I learned in 2008, is I think that the CTAs should double down on all of the elements of their philosophy and be unrepentant and unforgiving and never in talking about how beneficial their strategy and the portfolio is. It really is the perfect portfolio. We need to continue to talk negatively about a long stock convergent portfolio and the dangers of such a thing. We need to prepare ourselves and be ready when the stocks and the convergent trading blows up, and be on record as recommending this something much, much better. When this all happened in 2008, I asked myself, who was standing up there at the market peak saying, I don't really care that stocks are at all-time highs, that they've made all this money. This is danger. You know, the world is coming to an end. You know, the people who, when I go to the hockey game here in Tampa, they have these signs, the world is ending, you know. And so we need to have this sign that says your world is ending because it's true. What they're doing is very dangerous with adding, almost having a portfolio exclusive of markets and strategies that are convergent. We need to educate people on the dangers of being so stock centric. You know, one of the guys on Harold's podcast, I'm calling it Harold's podcast now. I'm trying to get brownie points with Harold, who I've never even met, but so what? I like this
You'll
guy.
have to have a bow tie, but Jerry, you'll have to have a bow tie.
you know, I like to wear kind of crazy socks and tennis shoes, and I have my own little outfit. And I really admire Harold with his outfits and the suspenders and the way he does the beard and the hair.
Lederhosen.
Yes, yes. So another reason to really like him, um, okay, you distracted me, but you know what I'm saying. We need to be the ones who, when people look back and say, wow, I mean, I didn't invest in CTA diversified trend following in 2021. They told me I should have. I can identify certain people, certain podcasts and clubhouses where they were saying this stuff. They were unrepentant. They were not sort of saying, "Oh, we all own stocks. Stocks are great. They're going to go up. We're going to ignore the 50 to 90% drawdown." But it's just a given in life. We're going to do this. No, there are people out there, and these people deserve rewards for warning me. I don't think there was that many people in 2008 who were giving off those warnings. The CTA industry is just willing to, okay, we're going to get 5 to 10% of these portfolios. We're going to add diversification, maybe some crisis alpha. I'll get 5 to 10% of that because I'm a big player in this little industry. And that's life. We're not going to tell people the truth of the dangers of not being diversified, and that there's no reason to assume that stocks have an inherent superior return or trending ability. We're going to add single stocks. We're going to give people the stocks that they want, but in a safe, prescribed way. We're like doctors and people who know better. And we cannot withhold this information in good conscience because we're 100% right. And, what if my business is small? What if I don't make as much money? Okay, whatever. That I can tell you should not be your highest concern. It should be to do what's right for yourself and for your clients. But we can go to another subject I wanted to mention. I had another good article from Mark, our colleague on the Top Traders Unplugged. He wrote an article about the bias against algos, which I thought was pretty interesting. And I guess he has read and quoted some scientific papers from people who measure things like this and study this idea. But here's what I tweeted. When judging algos and machines, the harm is the key criteria. What is the results of the decision? For humans judging other humans, though, there's a clear bias towards forgiving of harm based on judgment of the intentions. So if you're running a systematic approach with algos, then all I care about, all your clients, all the humans are going to care about is how did you do? And I'm going to be a tough judge and a tough grader here. You're not up to speed. It's been 6 months. You're not making it. You're out. But if you're more of a discretionary and you don't rely so much on humans, on algos, then you can explain your intents, you can explain your thinking, and probably get a lot of buy-in from others. Shouldn't we be trying to buy stocks at low prices and low valuations and watch them go up? Oh yeah, I think that's what we should do. Well, yeah, it didn't work out for me this year. I lost money. I underperformed. But your intentions were good. So, anyways, I don't know if you read that article, but I found it fascinating that if that's true, that we're always going to be, or for a while, I guess longer, we're going to be at a disadvantage for trading with rules and algos.
That hit closer to home than I'd like to admit. It's really hard to convince other people with your backtest alone versus the description of your intentions. The description of intentions is much more persuasive, it seems.
I think
Why is it though that your clients tend to tolerate drawdown in discretionary systems, yet the quantitative system, the systematic process that's been built with the understanding that there is going to be a frequency of drawdown to occur, they're less tolerant. That's the curious thing.
I think that might have to do with the one being more hands-on. So they feel like you're like the hand of God almost, where you can magically do make the changes to make it profitable. Whereas in the other case, when you let the system do it, it almost feels like a proximity issue, where it's like the system will just go down and nobody's changing it. Like I think there's some form of, how do I say it, proximity issue, where one is very hands-on, so they feel like you can make the changes to make it profitable again. Whereas with just following the system, they like our human nature just feels like it's gonna go forever. I don't know if that makes sense.
People in general are very unforgiving when the manager who's in profit suddenly finds that he comes out at a loss, and people would like to say, well, he could have taken profit, at that point. What was he doing? How stupid. So there definitely is this bias towards this short-term profit taking, which is so against what our technique is trying to achieve. So yeah, we're up against a rock and a hard place, trying to change the mindset to appreciate what we're seeking to do. People might understand it, in theory when we explain it to them and show them in a back test, but when you're on the right-hand side of the chart, trading's underway, people are monitoring their investments every single day, they will be very unforgiving if they see a profit turn into a loss.
This is very situational, perhaps only anecdotal, but the quant industry, so to say, here in Brazil is pretty young. There are few quantitative managers around, and the majority of them, they are they behave as a risk allocator of last resort, or risk manager of last resort. They have a bunch of models, and sometimes they're on, sometimes they're not, and it's at the discretion of the manager if they're on or off. It got me thinking, this last topic we were talking about. Perhaps this is easier to sell than a full systematic manager, because the manager is at the drive wheel all the time. The algos are not talking for themselves most of the time. It's the manager. So then he can always have this. Oh no, I was looking at the algos. I turned them on or off when I thought was appropriate, and so on.
I think people really dislike the the type of strict behavior that's required from following these rules, and the rules don't always work. They just work in the long run. And I think this really bothers people. I've seen other studies that show that if you just tell people that you will exercise a bit of discretion, 90% these rules with a bit of discretion, their anxiety goes down. We all know this is an obvious trade, parentheses, we don't, but you're really attacking what they thought they understood and believed about life. And they don't, like if someone was to come to me with a new trading idea that was vetted with a back test and a large sample size, I would be so excited about this. And just knowing that it's a matter of time. I'll win, it's just a matter of time. I just need to trade small, stay alive, this new idea, and following these rules ensure that I'm going to win. And I think for some people, this causes a tremendous amount of anxiety. It may have something to do with I've been doing this for 30 some years, right? I posted this other article about a US football coach who was using some of the analytics and probabilities to decide how to the decisions he was making on the football field to go for it on fourth down. And this is so out of norm for coaches. And it just, according to this article, it makes people's heads explode when they see it not work one time. And the explanation that, yes, we did lose this game, or more than one game, by trying this, by paying attention to our analysis and our analytics. But over time, this will help us win more games. And this is not sufficient to people who they've watched football their entire life. They know what's right and wrong, parentheses, they don't. And yet you're introducing this idea, taking this chance, and then saying it's analytics. And they're like, no, 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 I'd rather lose, and just lose conventionally. And so I felt like this was very similar to people's response to the markets and to trend and systematic type trading. Some people they would rather lose the old fashioned way than win, and and they have to absorb short-term losing periods with a crazy strategy like ours.
I half suspect, Jerry, that if you did a study of your clients that have invested in Chesapeake over the years, you would probably find such turnover in there that it almost mirrors our trade returns in that, we might survive off 5 to 10% of our trade returns. I'd say if you looked at your client base, you'll find that those that stayed with you are probably 5 to 10% of your total client base. The rest just couldn't hack it. I'd be interested to see if there's a correlation between the investor sticking power and the performance of our models.
That's definitely true on our mutual fund, where people can get in one day and get out the next anonymously. Some of my clients that have been around in the private fund for 15 or 20 years, I think they're afraid to call me up sometimes and get out, due to volatility. They don't want to do that. And we did have one long-term person redeem, after 15 years or whatever, right before we took off last October, and we're up 50%. So, the timing was really bad on his part. But that's another thing I think is kind of dangerous, is giving people a lot of liquidity, daily liquidity in the trend following mutual funds, CTA mutual funds. That is not going to work out well for most people.
I wanted to like your Charger sabermetrics tweet, Jerry, but as a lifelong Chiefs fan, I couldn't bring myself to do it. So, but I thought that was an interesting series of tweets that you had there.
Yeah, that was fun. You know, another thing that was kind of interesting about that is how, I mean, my favorite coach of all time, Belichick. You know, he has the best performance of all time. Maybe you can't like him because you're a Chiefs fan, and if they end up playing the Bucks in the Super Bowl, I won't like him either. But you know, he has this amazing record and amazing, unique way of doing things, and he will not accept this analytics. You know, and so I'm probably close to his age, and yet for some reason I just I'm so different than that. I mean, I love analytics. I love systems about everything. I want to systematize everything in life and make everything similar to you know the investing process I have. So it's just kind of weird that when yeah that he did not embrace more of a analytical approach. I was kind of disappointed in that.
Yeah, I wonder if there's been some sort of psychographic study as far as those of us that tend to be more concrete, sequential rather than random abstract in our thought processes, because it goes far beyond trading for me as well, as far as that systematic process of life and philosophy.
Guys, I need to go now. I would like to wish you all a Merry Christmas and thank you again for the amazing talks all this year. Goodbye.
Merry Christmas, man.
Cheers, Bruno. Jeff, what's your New Year's resolutions for 2022?
More studying, more researching, more reading, everything more. Yeah, and just keep on top of these podcasts and obviously the Clubhouse. Just trying to get more knowledge and trying to excel that way. Also trying to do more on coding. I don't know if you remember, like a half year ago, I asked the question if how to keep on top of the trading schemes, and coding was one of the things. So literally, I started the week after that, and I've really excelled there on that part. So yeah, I'll definitely continue there. Just trying to grow, really.
You know, I think one of the things that was important for this year for me was just remembering what I have learned over the years as what's important, and not forgetting those things and writing those things down and committing to them all the time, and not letting small things get in the way, markets and trend and volatility. And so I think that's what's happened over the years, is that at the same time I was making New Year's resolutions to do something different and better, I was forgetting. And it's just shocking that so much of what I learned in 1983 just keeps getting reaffirmed all the time. These broad principles of, about what is success and what is failure. Um, Success, following your system. If you follow it, you can't fail. And then if it does fail, you just trade a bit smaller and do your best to keep going and be different and embrace being different. So I think that's important as well. I like to write down all the things that I believe that are true and revisit that, and then write down the things that I refuse to do, you know. Um, and because I have been exposed to so many smart people in the Clubhouse and over the years, that there's no reason for me to ever lack confidence or never forget some of the things that I know to be true. It doesn't mean I can't improve. Um, and hopefully next year I'll have something other than something more kind of like cool and profound, other than I'm going to try to find some more markets. But I do think I'm going to, I get a lot of inspiration, as I've said, from other traders who I'm able to find out what they're thinking with their newsletters or watch their podcast and copy them. I need to do some more research on because I was reading about one trader who's really large and hasn't done well because they have too many moving parts. I think lots of vol targeting is one of their least problems that they have. They do lots of other things versus just hanging on to the trends. But I was reading their newsletter recently, and they were telling their clients about how many currencies they trade, ones that I had never thought about, like the crosses, like New Zealand yen, crossing all the currencies with the China currency. And so I'm going to get back into that. I think I can go to 200 markets if I can trade every possible currency pair. But I'm skeptical about those markets. I'm not sure if they're worthwhile to add. But I do need to come up with a new thing other than just adding more markets.
What I really like is having a to-do list and then literally scratching any item that I have. It's such, for me, it's such a simple thing, but it really feels like you're progressing. I almost feel like I'm playing Mario Kart or something like that. Having the full list and just striking them off. So
I find it very interesting. I like destructing conventional wisdom. So when I reading Twitter and reading people's letters and stuff to investors and stuff like that, I love sort of interrogating it and finding what, stripping back to simplicity, finding what the potential assumptions are and in what they're doing. And I think Moritz and Jerry are onto something when they're always sort of seeking to strive for this simplicity. And I think perhaps that's sort of the area I need to focus on now is get back to simplicity.
I get forced back there mainly because I see mounting evidence. I get reminded that it's just there's ramifications to trying to be more in control. There's negative consequences sometimes. I mean, I'd like to be more in control of some of these trades and not just be watching my equity go up and down based upon these large moves and these trends. But okay, then what are you going to do? And so I'm going to come up with some rule or some idea, but then I'm not going to like the overall performance of implementing that rule on all the trades in the past or in the future. So yeah, I'm just continuing to be forced into realizing that you can follow these systems, you can make this money, you can preserve capital by my definition of what capital is, but you're not in control. And I would really I've been toying with this idea. I have a good staff, we have good infrastructure, from a back test and a trading, daily trading. And I'm just wondering if I could wean myself off of watching the markets every day, because I'm following the system, I'm committed to it. I've got people implementing the trades, they're very talented. And so maybe I don't watch the markets for a whole week. And then I build up to a month. And I'm not getting psychologically damaged by the ups and downs of my equity. I'm going to be following my system because I'm the only one who can override the rules. And I'm just wondering, can I handle this? Is this the evidence that I am truly committed to following the systems and the rules that I'm so confident? If I gave money to Richard to trade, I wouldn't even lose a bit of sleep. I would just say, I gave him the right amount. I'll be happy. It'll be decent. It'll be good performance. He's following the trends. I like his philosophy. And I'll get the monthly statement and I'll be fine. I'm just going to be totally fine. Maybe
Just
even
watch out
with
for the Christmas
Mulvaney.
party, Jerry.
Maybe even with Mulvaney. Who knows, right? So, but oh my gosh, my trading, my system, I talk like I'm very systematic and disciplined and I have all this confidence in it. Well, then why are you checking the charts every 30 minutes?
I think we could do that. seriously, I think if we keep that busy in our research and participation in podcasts and always looking at the philosophy, we don't need to look at those charts. I tend to agree with you, Jerry. I reckon we should set ourselves a goal next year of having maybe a week or 2 weeks where we actually do not look at a chart.
I think if you have like alerts for those critical cases where something really is wrong, and then for me personally that will work.
Well, I think, I mean, most of us, if, and I don't mean to overly simplify it, but if you're a classic trend follower, whether you're doing, breakout or point and figure, you should be able to trade off of spreadsheets intraday alone, period. Just, so yeah, I think, because I think we're all addicted in some way, shape, or form to at least checking the markets.
Hi, everyone. Happy holidays. Merry Christmas if you celebrate. I just want to let you know I feel like I'm so fortunate to find a group and to be part of it. I have a question for Jerry and Richard. Correct me if I'm wrong. So it seems like you guys are very still bullish about China. Even I'm originally from China. I speak perfect Chinese. And I mean, even for me to go back to China is going to be, it's hard, it's so hard. I mean, I have to take maybe 3 weeks, 4 month quarantine, so I can't go back. So here's my question for Jerry and Richard, and like, am I wrong? Am I right? You guys seems like still very bullish about China, despite the fact of the political environment. I mean, let's say the government is taking reins of the entrepreneurs, and it seems like it's stifling the economy. And I have a cousin who is a billionaire. I mean, of course, he doesn't live in China anymore. And he said, whoa, I have friends, they have 500 million has been reduced to, let's say, 50 million. So under this kind of environment, do you mean that means maybe it doesn't matter what kind of environment the country is, as long as we are doing trend following? Is that right?
Yeah, look, as far as China goes, it's an interesting, interesting world in China, because by far the vast majority of traders in China are not institutions; they're retail traders. So the market behaviour of a lot of Chinese markets, they are very trendy markets, and I think when I used to listen to Perry Kaufman a lot, and the way he used to look at the emergence of markets as the life cycle of markets, we see that when there is a particular dominance of a particular participant in that market, such as a retail trader or whatever, the behaviour of that market is expressed differently to when there are a vast array of different participants doing different styles and techniques. So in our mature markets in the US and in Australia and in Europe, they're dominated by institutions, they're dominated by a lot of convergent participants, convergent models. But China's different. It's sort of like the wild frontier as far as emerging opportunity, emerging markets, and there certainly are big trending opportunities in some of their markets over there. So that's why they're attractive to me. But you've got to counterbalance that with the counterparty risks that you face in trying to trade over in China. That's why sort of I need to sort of use vehicles that are established in say Australia and Europe and the US to be able to trade those markets, as opposed to directly investing in China itself. But Jerry would know more about this than me.
Yeah, I mean, I think we want access to China markets in commodities, and we don't really particularly. We would prefer that this unique commodity diversification was not in China because of all the obvious reasons. But being bullish on China, I think I'm short a couple of China stock indices, so I'm not bullish, on China, but I do for selfish reasons want to trade those China commodities. Getting back to the Herald thing, another thing I just thought about. I don't know if you saw this, Richard, but Um, oh, this one guy from one of the CTAs who bills themselves as trading exotic commodity markets, commodity markets, and not trading New York sugar because it's, I don't really subscribe to this idea that, I mean, I'm kind of agnostic, but I'm not going to ever go on record as saying I think that this market, because it has these characteristics, are going to trend better than other markets because they have these other characteristics. And so I think it's kind of, no, I'm not going to do that. And I'm going to trade all the old markets, all the markets where there's dominated by institutions. And I'm going to look for diversification. And if I stumble onto some markets that have less institutional presence, great. That's just fantastic. I'm pretty sure I'll leave this earth never really figuring out whether some markets. It was pretty obvious that I should have traded the thinner markets or the more exotic markets. But I thought one of the things this guy said was kind of funny because there was a lot of good conversation on that, but he was like a little too much marketing for me. And he was basically talking about CTA performance. And he said, well, the typical CTA is a Sharp of zero point 0.5, zero point 0.7 or whatever, or something like that. And then, but, the CTAs who trade these exotic commodities, i.e. his firm, oh, well, our
Was this
Sharp's
the
going to be,
foreign capital guy?
yeah. And he was like, oh, our Sharp ratio is 1.0. And I thought, you know, you may have a 1.0 Sharp ratio. And I've seen some of their positions because they file a 13F. And I snoop around everybody's 13Fs, which is basically a quarterly report that the government in the US mandates that if you have over $100 million under management, you have to disclose your stock holdings. And this floor in court, they're heavily into US equities and a lot of ETFs. So they want to call those exotic, whatever. But I was just thinking, whatever you're doing to get that one Sharp, it's convergent crap. Okay. You're doing something, that's taking smaller profits. And that's what's determining your 1.0 for now. Good luck. But for now, you got this 1.0. And it's not these smaller markets that have these amazing trends that you're not going to pick up. That's I can't go with that.
I thought exactly the same thing of that bloke.
I would just love to. I mean, to some degree, I'm like looking for someone to put me in my place, so I can say, "Damn, that guy is super smart. I mean, he is doing it right, and he's teaching me a few things, and he's got billions under management. And I could learn from this person. I'm like craving that, so I can just like make this guy into this rock star, this woman, and follow them and learn. You want to learn from me, you want to learn from Richard. Well, we want to learn, and we are craving, people who are doing it better. And it's hard. It's hard. Maybe I'm just too close-minded, and they're all around me, but I refuse to um, get off my principles that I'm going to die with.
Jerry, when was the last time you caught up with Rich Dennis?
We had a turtle reunion a bunch of years ago, and he was there. And yeah, so it was, and Bill Eckhart was there. We had a dinner, big dinner in Chicago. A lot of the turtles were there, and Rich and Bill were just bigger than life, and they still are. And it's just like it's hard to describe, but the biggest takeaway that everyone should take away from the books and the talk about the turtles, and I've mentioned this every time, is that these were like the smartest guys on the planet. And this is what they came up with. And so for me, I don't have jealousy of, boy, if I'd only worked for Julian Robertson or Paul Jones or someone else, because you could walk into a room and listen to these guys talk, and you were like, oh my gracious, these guys are from another planet. It wasn't just what they were saying, it's how they say it and how they understood it and believed it. And this is what they came up with. And so that was easy for me to believe. And I keep coming back to, whenever I've had underperformance that I regretted, it was because I just got away from the principles that I was taught. But yeah, Rich was quite a genius. And but later in life, I kind of think I realized that they were not so much diehard trend followers as just diehard system traders, rules based, math. And because I think Bill trades very short term now and likes to say that he does nothing similar to what the Turtles did or do. And so I think I'm at peace with that because they, at that point in time in the 80s, rules that centered on shorter term trend following was what worked for them and for us. But that never meant that trend following was something that you had to use or force yourself to use. I mean, I did because I was a diehard trend follower, but I think now I realize they were just diehard system traders, and whatever they came up with later, it did not have to be this medium term trend following.
It'd be great if we could get Niels, perhaps, if the opportunity arises next year, to get Bill and Rich together to basically talk about how they've seen the industry change, what they think about it now, what they think about the methods they deployed, all of that sort of stuff. It'd be very interesting.
That would be very interesting. There's some podcast out there with Niels and Rich and me, and Brian Proctor, I think, was on one of them as well. And if you can't pick up in Rich's voice, the depth of knowledge and thoughts, I think it's pretty easy to sort of see what I'm getting at. Just commanded, and they were the most nicest, gentlest, understanding, forgiving people, on the planet. You were dealing with these people and you're just asking them to follow the rules and behave themselves. And it was tough, because we were immature and we were making mistakes and thinking incorrectly. And yet all we had to do was follow these rules and grasp this philosophy. Um, Another thing too is I watch sports and I read, and I'm interested in sports and this process-driven life that smart people and successful people embrace. And I just was thinking recently that how the Turtles could have been so much more than a commercial success than they were, but we just didn't have enough years with those guys. We needed like a good 10 or 15 years. And so I think that was kind of a bummer. We were so close to genius people, but it's not just the rules. You have to know them and talk to them and clubhouse with them, right? And to get confidence and deeper understanding. Yeah, so I think that was really 4 years was not enough with those guys. And I think I read about the Tiger Cubs and those guys being so successful, and Julian Robertson, and they probably spent more time with their mentor than we were able to.
So, Lulu, any resolutions for 2022?
Oh, you read my mind, Richard. Oh my gosh. As I said, I'm pretty new, but I see the imminent danger that I have to do diversification. So that's my New Year's resolution. How do you think?
Definitely. I think diversification is key. And so what are your thoughts there?
What my thoughts be?
Yeah, so what are you planning to do in relation to diversification next year? Is it sort of testing? What are your plans?
Yes. Let's say commodity, option, future trading. Um, but I mean, it seems like overwhelming, but I'm not deterred.
Yes, it's very hard to sort of, you've got to find your platform, find your markets, all of that sort of stuff. So it is it's a bit of a minefield, but stick with it.
Yes, just like Jerry said, with the people like a great people from another planet. That's the feeling I'm here with you guys now. So I know this is a lifelong learning. I'm grateful for that.
So it's being close to 2 hours. Does anybody who hasn't spoken want to say a few parting words for encouragement or ask a question on this Christmas Eve? And I'm pretty sure we'll be right back at it next week on New Year's Eve. But just give anybody a chance who wants to have the floor for a few minutes. Hi, Andy.
Hey, how's it going, Jerry? I just wanted to say a thank you, kind of from a different perspective. I'm not necessarily a classic trend follower like you guys are, but I just want to share that I get so much from this room. You know, I really respect what you guys do, and you've helped me out in just a lot of ways with the fortitude of holding on to certain positions. Just your stories of, you know, Jerry's and a bunch of you guys are just real traders, you know, with big accounts under management, and it's inspiring not just to the trend following community. And I'm in here every week that I don't have carpool or whatever I have, but I just really appreciate it. I want you guys all to have a Merry Christmas, if that's your thing, and just have a great year. And I'm really appreciative to be here. Thanks.
Well, Father Christmas is already here in Australia dropping off presents. I don't know if you guys know what the Southern Hemisphere people have to go through to get on these Clubhouse sessions, but I'm telling you, they're late night sessions.
We appreciate it. You know, we used to start at 10 a.m. and that must have been, so I'm glad we started at 8 a.m. now, and we could, you know, maybe move it to 7 a.m. or because we love having you on here, and it's been a lot of fun to get to know all of you guys this year, and I look forward to next year. We have a new person coming on the Top Traders Systematic Investor podcast, a new regular from Abbey Capital, which I'm looking forward to, you know, because that'll give us a different perspective. Those guys are very successful and at putting together CTA, groups of CTAs in mutual funds or in bespoke products for people. And so that'll be a very interesting perspective from our new colleague. And so that I'm looking forward to next year on that as well. But a couple people wanted to get on, and I tried to get them on, but something. I'm saying yes, but they're not getting on stage yet. So with that, I'll say goodbye, and we can wish everybody a Merry Christmas and thank you for participating. It's been fun. Thank you, Richard, for recording the sessions and putting those out there for everybody. And anyways, much thanks to everyone. Merry Christmas, and I'll see you next week.
See you next week.
Bye, y'all.
See you, everyone. Happy Christmas. Bye.
Thank you.
You
Merry
everyone.
Christmas.
Merry Christmas.
Bye.